few refinements that you can integrate into your supply and demand zones are the concept of inside bars, how we can view continuation patterns on higher timeframes and what they look like on lower timeframes, and finally, what wicks represent. These are all refinements that relate to lower timeframes, but you can use the higher timeframes to build upon them. And what I mean by that is if any one of these three situations arises on, say, a 1 hour chart, and you're not comfortable going down to a 15, 5, or 1 minute chart, you'll still be able to understand what is happening on these charts, which will allow you to still progress within your trading, but not need to go down to those lower timeframes in order to take those particular setups. So the first thing that we're going to look at is the concept of inside bars. And what is an inside bar exactly? An inside bar, quite simply, is a candle that rests within the previous candle. So in this example, we have a down candle or bearish candle. The next candle is a bullish candle. And what you can see is this bullish candle didn't break the high or the low of the bearish candle. It actually rests inside the bearish candle right here. And then what we can see is price then moves back to the downside quite rapidly. And if we just think about what this is implying on a lower time frame it back to our models of creation of supply and demand, what we can gain from that is that this is actually a continuation model of a supply zone being created, whether it be a pivot created supply zone continuation or a range bound supply zone continuation. And what this implies on that higher time frame is what this would be on a lower time frame. And again, what this allows us to do is if we see this type of price action on, say, a 1 hour chart, and we're not comfortable going any lower than that chart, we don't need to, because we understand that this inside bar is more than likely a range or pivot on a lower time frame. Generally speaking, what an inside bar is a range on a lower time frame. And what we understand about ranges are that they are an area of interest where price is held at fair value and multiple orders are changing hands, or on the flip side, low momentum. And the way we are able to discern whether it's low momentum or high momentum is what happens next. And in this case, we see a rapid move to the downside after the creation of that inside bar or range. And we can derive that this is then a supply zone that we would be interested in for price to return back into and look to trade. Now, on the flip side, the same can be said for a demand zone where we have a move to the upside that creates a high, creates a low, and we have a bearish candle. It could also be a bullish candle. In this case, this could also be a bearish candle if we don't actually break this wick. The main thing about an inside bar is that we have one candle, the next candle stays within that candle, and then the next candle breaks it. And that becomes the most important part. Whether it's bearish or bullish isn't as important because of the concept that we understand happening. And this really is important when we understand the fractal nature of the markets and how something happens on a higher time frame and what it's doing on a lower time frame. So when we go back to the demand zone, what we can see is we have this inside bar, and then we have that rapid move to the upside. Again, this creates a demand zone, whether it be a pivot demand on a lower time frame, or, well, even conceptually, if we're just looking at this, if we get this move to the downside, a sharp move to the upside, and then a move to the downside, that's pivot created supply. Again, on a lower time frame, it could also be a range created supply. And as well on the demand zone, we get that sharp move to the downside followed by a move back to the upside, pivot created demand. Or it could be on a lower time frame, a range, which is what an inside bar does imply as well. And again, what we're waiting for in both situations for price to return back to these areas and give us a reason for entry. Now, moving on, what we will see is, again, a refinement that we can use to understand the fractal nature of the markets. And in this case, what we have is price moving to the downside. We have a lower wick, an upper wick on the next candle, and then another move to the downside. And what this is conveying is basically this type of phenomenon, or even this type of phenomenon on a higher time frame. So what we can see is that this is actually potentially this on a higher time frame. And what we're seeing from a price action perspective is, again, a continuation model, that pivot supply being created, or even potentially on a lower time frame, a range being created that we can use as a supply zone. And on the flip side, we see that same thing being created on demand zones, where we have this bit of price action that either creates that pivot created demand or range created demand, depending on the fractal nature of the markets and how supply and demand is created. So again, what this allows us to do conceptually is we can use lower time frame refinements without actually going on to the lower time frames, whether it be utilizing the inside bar technique and understanding that that is a range on a lower time frame, or also just looking at the way candles interact and seeing a very quick pivot in the market. We can use that and understand that that is also a continuation pattern that is happening within the market that is either creating supply or demand zones. And then finally, the last refinement that we can use involves wicks, and more specifically the large wicks that we see when zones are created. So in this first example, what we see is that price has a fairly large wick to the upside. We get that move to the upside and then a rapid move to the downside. We can say that a supply zone has been created, and again, we'd be waiting for price to return to that supply zone. Because this candle is relatively small with a large wick, we can map out the entire supply zone using both the candle body and the candle wick. And again, if we're looking at a continuation styled setup, this would be a pivot supply continuation, or this could even be a range created supply zone continuation, or again, it could be a pivot created reversal supply zone, or a pivot range bound created supply zone. So they work regardless of the zone being created, but what specifically is important is how we actually are drawing the zones. Again, like I said, the candle body and wick are relatively small, so you can use the entire zone. But if we get into a situation like this, where we have a very large wick on either the downside or the upside that creates a supply or demand zone, if I just unlock this and move this to the downside, what we can see is that ends up creating a very large supply zone. Yes, it is valid, but we're looking to refine our approach and understanding the fractal nature of the markets and what this wick implies. If we look at this wick on a lower time frame, what we can see conveyed in this little bubble here is essentially a supply zone being created. And that's what you will see inside of that wick on a lower time frame. You'll see the creation of that within this wick, whether that's a range created supply. Because if we just look at what the price action is conveying in this candle, we opened here, we moved down a little bit, we moved to the upside, we came all the way to the upside, and then we rapidly moved to the downside. The candle closed, the next candle comes up and then moves. If we just look at that bit of price action, what we can see, depending on the price action that leads to this, is we just see a pivot created supply. If we were to look at something like this, there's your continuation model. Or what we can see is even just something like this, where we have that large range, and then we get even a more fractal range or pivot being created inside of that wick. But all is to say that what we're doing with drawing our supply zone in this case within just the wick and not including the body is simply a refinement, using the understanding that what's happening on the lower time frame within this wick is simply a supply zone being created. But again, there's nothing wrong with using the entire candle for mapping out your supply zone. This is simply for refinements and just understanding the fractal nature of the markets. And again, the same is true for the demand zone, where within this large wick to the downside, if we were to look at that on a smaller time frame, what we would see is either a pivot created demand zone or a range created demand zone. More specifically, when we see these wicks, depending on how far down that you're looking on a time frame, say this is a 1 hour. If you look on the 1 minute, generally speaking, you probably will see some sort of range. But if you're looking at a 15 minute, generally speaking, you're probably going to see more of a pivot created supply or demand zone being created within this wick. So something to keep in mind. But again, these are all just simple refinements that you can use to understand the fractal nature of the market and how supply and demand relates to these concepts, which will make your trading a little bit easier, especially early on when you're maybe not as comfortable going to the lower time frames. This shows you that you don't necessarily need to go down to those lower time frames because you understand what's happening conceptually on the lower time frame without actually going onto the lower time frames, and the power that this is granting you if you're able to use these concepts correctly and understand them properly. Understanding the fractal nature of any market, how a higher time frame and lower time frames, what they do to work together or work against each other and understand the framework or the footprint that we're looking for. It'll make your trading so much more easy to understand and navigate through if you can look at this and go, I know what's happening on a lower time frame. I'm not comfortable trading on that lower time frame, but I understand what's happening, so I know that I can use this concept to build up trade ideas. Because I think it goes without saying, there are many times when we rush to go down to a lower time frame and we get lost in some of the noise or what seems to be noise. Whereas if we stayed in a higher time frame and just seen this sort of phenomenon happening conceptually and understood what was happening on that lower time frame, it would make our lives so much easier. It would make our trades that much easier, and we would be left with higher probability trade ideas that don't involve too much afterthought or don't involve you second guessing if that trade should or should not be taken. Again, we combine these with how price returns to these zones, whether we get the rounded return, whether we get the corrective return, or if we get the V return. They'll all factor into how we look to trade these zones. But again, these are fractal refinements that we can use to understand supply and demand zones that are on the higher time frames, but are actually built on the lower time frames.